Howdy. Next installment of the video, talking about taxes. The next one I'm talking about is the mortgage interest that you can deduct from your taxes if you itemize. And here we go. So the main thing here is the home mortgage interest deduction. Basically, you can take the total amount of taxes that you paid on your mortgage payment throughout the year, and you can deduct that from the buckets of income that fill the tax brackets for the calendar year, and you can subtract that total amount. I mean, for most Americans that are getting a 15-year or 30-year mortgage, you can think about that, how the mortgage is amortized. You pay a high percentage of interest in the beginning, and as you pay over time and the principal balance goes down, you pay less interest towards these payments. So if your payment in the beginning of your 30-year mortgage is $1,000 a month, on average, just for easy math, of that 1,000, let's say 900 of it goes to interest and 100 of it goes to your actual principal of your mortgage. Once you get to about the half-life of your mortgage, if it's a 30-year mortgage, you get to year 15, then if you still make that same $1,000 payment, about 500 of it, 50%, would go to principal and 500 of it will go to the mortgage. And as you move closer towards the end of paying off your mortgage, the payments are lopsided the opposite way, where most of your payment will go to principal and a small percentage of it will go to mortgage. So amortized mortgages are front loaded. In the beginning, you pay a lot of money in interest, but you don't notice it because you just think it's your monthly payment. But that payment, if you break it down, 80–90% of it is going towards interest and not towards actually paying off your home. So in those time periods, it's a benefit to use the mortgage interest tax write-off because most of what you paid for your mortgage throughout the year was actually paying interest and not actually paying your mortgage. You can deduct the mortgage interest on up to the first $750,000 of indebtedness for your home. And the great thing about that is the average price point on homes in the U.S. for most general Americans is around $250,000–300,000. So most of us can all take this deduction because our homes aren't mortgaged at over $750,000. Now, to qualify for this, you got to see what is considered a qualified home, right? That means the home that you basically live in, but it can also be a condo, mobile home, house trailer, boat home, something that has sleeping, cooking, and toilet facilities, right? So if you have anything like that, you can do it. You can even have a second home. As long as you don't rent the second home out or use it to make money for cash flow and stuff like that, your second home, the interest that you paid on that mortgage can be deducted as well. And this last one is a really serious thing because I know some people this has happened to where their home was completely destroyed by a fire or a hurricane or a flood, etc. But you can still deduct the interest on your home for a reasonable time after, as long as you're looking to repair it and get it fixed, or sell it on a home that's completely destroyed. So even if you've lost your house, as long as you still have a note and have to pay that mortgage, and from American folks out there, deduct the interest you file a return for that year. It can be owned. The home can be owned by either party if you file jointly. If you file separate returns, one of you has to figure out who's going to file for the deduction. You both can't deduct for the same property. So take that into account. And for persons that are uniformed services or work as ministers, clergy for churches and stuff like that, or military, even if you receive a housing allowance for where you live, you can still deduct the mortgage interest from your home, even if you get money to help pay for where you live while you're there. So that's another benefit to people that, work in ministry or people that are in the military. Great stuff. The next topic. Now, should I itemize? I mean, you get a standard deduction, right? That's the amount the government's going to give you just for being alive and living another year. Should you itemize? My opinion, if you can quantify enough expenses to get over the standard deduction, then itemize, because that's more you're taking off your taxes. I mean, we looked at the math of this earlier, and if you watch my other video on common tax misconceptions, you can see how we need to fill these buckets. Well, if there's a way that we can lower these buckets of the tax brackets, oh my gosh, we're just putting ourselves ahead. It's not a loophole. It's not anything crazy. It's literally written in the tax code. I'm showing you all this from the IRS website. So when people say, oh, there's a loophole, they're doing this, they're doing that. No, they're not. They're following the letter of the law and minimizing their expenses. That means if we can itemize quantifiable deductions and we can itemize more than $27,700 worth of deductions, it'd be worthwhile to itemize instead of taking the standard deduction on our taxes, which would thus lower our tax burden or increase our tax return. All right, so if you've been watching with me this long, I'm pulling this number out of my butt, out of thin air. I don't think it's realistic, but most people will have even more than this because this number is not real. It's actually a lowball number. $1,000 a month for 12 months give you $12,000. If 90% of that is going to interest from how amortization works, $10,800 is going to get taken off from your income for the year, which gets us closer to beating the standard deduction. And our goal here is to beat the standard deduction. If we can itemize and justify enough quantifiable expenses to be higher than what the standard deduction is, then guess what? We can choose to either take the standard deduction or take our itemization. So if we can get our itemizations above $27,700 for a married couple, then we want to take the itemizations and get a bigger tax return or owe less in taxes. Now, again, for this example, let's say you're earning $60,000 per year and you decide on top of what you've already done to give 10% of your income to a qualified organization. If and when you do that, you take that $6,000 off of the 16,900, and now we only have 10,900 more to write off before we beat the standard deduction. Now let's talk for a minute about these qualified organizations. Most of them are charitable organizations. We have a state or United States possession for public purposes, District of Columbia. So that could be like if you donated to the museums. A community chest corporation, trust fund, or foundation organized in the United States under the laws and District of Columbia for charitable, religious, educational, scientific, literary purposes. A church, a synagogue, religious organization, a war or veteran organization, nonprofit, volunteer, fire company. And we have a few more here: civil defense organization, domestic fraternal society, a nonprofit cemetery. And then the timing of the contributions has to be in the tax year that you want to deduct it, but the deductible amounts. You can donate property other than cash. So think about times you go to Goodwill or go to Salvation Army or other places. You just have to write down the fair market value and keep track of it. First off, my opinion on charity is we should be doing more charity to help our brothers and sisters and people that are around us that are less fortunate. But also, there are so many different ways that you can find ways to give to other organizations and still get a write-off for it, so you get a benefit from doing it as well as the excitement of helping someone else. I don't see why more people don't do it. But that's here nor there. I don't want to tell people what to do with their funds and their money. I just want to give them ideas. But wait, there's more. So the first I want to talk about is self-employment. If you own your own business, or you're a sole proprietor, or you work for yourself, or you have an LLC, whatever it is you have, every mile you drive for your business, you can take off 65 cents and a half per mile. That means if you drove 10,000 miles in a year for your business, that is $6,550 more dollars worth in mileage that you can take off. If you volunteer for a charity, like we just talked about, let's say you volunteer for your charity every week or every month, or you drive around for your charity, every time you calculate the time you drove from your home to the charity and back to your house, you can calculate that mileage, count it all up, write it off. Same thing for medical expenses and moving. Those are a little more random. Those don't happen every year. Hopefully you're not having medical emergencies or having to move around a lot. But if you did, these are things that you can deduct. If you quantify the expenses, you can deduct it. And all you have to do is have a simple log. Simply write down on your phone the date, where you traveled to, and Google the mileage. That's all you got to do. It's that simple. It's a little bit of work, but you can do it. And just to show you I'm not talking out of my butt, record keeping. The law requires you to substantiate your expenses by adequate records with sufficient evidence to support your own statement. So if you have a log on your phone, or you keep an Excel spreadsheet, etc., and you write down what the mileage is, like the date and where you went and if you paid tolls or not, and then you add all that stuff up at the end of the year, that is your mileage. That is your log. That is your adequate and sufficient evidence to support your statement. Also, if you are volunteering at some charitable organization, I mean, the people that see you there every week or every month literally know that you drive there and you volunteer every week or every month. And plus, a lot of places you volunteer, you got to check in. So when you check in, there's some sort of log there to show that you were there. So if you did get audited and the IRS was not going to believe your verbal word that you said, hey, I volunteered here, you could always go and substantiate it with records. Okay, so to recap, we started with $27,700 for a married couple, the standard deduction. We took $9,800 off for the mortgage interest, leaving $16,900 to beat the standard deduction. Then we took $6,000 off for charity because we, volunteer, pay tithes, do other things like that to charitable organizations. That brought us down to $10,900 to beat the standard deduction. We still didn't calculate the exact amount for mileage for a business, for a personal business, mileage for a charity. We haven't talked about the earned income tax credit. We haven't talked about a child tax credit. We haven't talked about other deductions that I didn't even mention. So you can see how if we looked at a few more of these and your tax professional asked you a few more questions to find out other ways that you could deduct and get some deductions in your life, you can easily probably beat the standard deduction and itemize your taxes and increase your return or lower the amount you owe in taxes. I hope this has been helpful. I hope the information, is something that you can think about and use to your advantage, to talk to a tax professional who will know other strategies and ways they can apply to your specific situation to help you. It's something to look into. I mean, there are a lot of other details to a lot of these scenarios that I didn't mention or put in, but I just want you to get the general gist of the information and how you can start thinking about it and applying it, asking questions, so you can find out the specifics and see how you can get it to work for you. See you next time.